Diane, I'll give it 1 minute for anybody else joining us right on the hour, and then we'll go ahead and go.
Okay, that sounds good, Tony.
Switch over to the regular screen, Diane, and I'll kick us off.
Yes.
Well, good morning. Thank you for being with us today. Coming over just after Memorial Day, we appreciate you joining us for I think will be a very informative discussion. I'm Tony Stamas, President and CEO of the Midland Business Alliance, and I know it's been an incredibly challenging week here in our community. Certainly our thoughts and our prayers are with all those that have been impacted. We're grateful there's been no loss of life, but we also know that there's a long road ahead. I'm sure with all of you, it was inspiring to be out this weekend, seeing people and being able to help our neighbors, friends, family, and strangers. And you see that just as communities of people coming together, as churches, people from frankly around the nation have come together. So it is inspiring to see people help, and we know we're going to need to continue to do that. We do feel it's important to make sure that we're communicating, and that there are so many challenges at this time, helping everybody with the urgency and the needs they have for the flood, and some great resources through the United Way Midland Area Community Foundation. But also we know that we're looking at reopening, and businesses, and some are already reopening, some are on a different path, and so we want to make sure we're providing everyone the tools they need for that. And to that end, we've had a couple of videos the last 2 Fridays, one on the work share that we talked with the legislative director for labor and economic opportunity, which we think can be an important tool that a lot of folks are going to look at using. And then just this last Friday, with our sponsors today, Warner, Norcross, and Judd, we had a webinar talking about, okay, what are the legal responsibilities as businesses and organizations reopen? So those are going to be on our website. We're going to continue to share those and do other things like that. If you have suggestions, please let us know on that. We want to make sure that we're giving everybody the tools as we kind of move forward. So welcome. This is our second Issues and Answers program of 2020. Obviously, a lot has changed since our first one, but I think this is still going to be really an important information source, hopefully, for all of you. Our Issues and Answers program is designed to focus on timely issues and public policy issues to help inform our members and point them in the direction for resources for insight. And that's what we're going to be doing this morning. We have a pretty comprehensive program, so I want to welcome you. Continue enjoying your coffee. That's the advantage in terms of this virtual setting, but we're going to get right into the program. As I said, in terms of the COVID-19 issues with this as well, please always give us your suggestions, your ideas, either to Diane Middleton, our Vice President of Advocacy, Joe Crush, our Chair of our Business Advocacy Council, or certainly myself or anybody on the team. We're particularly interested in topics that directly impact our members or are soon to evolve into public policy. So we want to hear from you. You're on the front lines, and please give us your thoughts and your ideas and your suggestions. So today's event sponsor, as I mentioned before, is Warner, Norcross, and Judd, LLP. And we really thank them for their support for this year's entire series of Issues and Answers programming. John Lauterbach from Warner, Norcross, and Judd, a great friend, and I know so many of you in our community know and I've had a chance to work with, is with us on this morning. And so I believe he's traveling, so we may just hear his voice, but I'd like to invite John to share a few words. So John, I'm going to turn it over to you.
Thank you, Tony. I am driving this morning. I'm heading to our Grand Rapids office for the first time in 10 weeks. It feels a little weird after having been working remotely for all this time. So, but I did safely pull over to spend a few moments. First of all, thanking the MBA for the Issues and Answers series. And before I get to putting in a plug for our firm, I want to put in a plug for our community. This past week has been incredible. in some of the worst ways and in some of the best ways. The devastation around our community literally takes your breath away, but at the same time, our local emergency management personnel executed flawlessly. 11,000 people were evacuated safely in a matter of hours, and no one died, and at least there are no reported serious injuries. I could not be prouder to live in a community where people cooperate and look out for each other the way we have, and Warner Norcross couldn't be prouder to be in the community as well. So the next time you see your county commissioner, your city council representative, if you see Bridget Granston or Brad Kay, just thank them for what they've done for our community in the last week. Okay, so with that, Warner is proud to sponsor the Issues and Answers series. I would invite you all to take a look at our COVID resource page on WNJ.com. We have, since the stay-at-home order went into effect on March 23rd, we've been posting on the website COVID questions of the day that address issues affecting HR, business operations. We're now shifting gears toward getting back to work. We think there's a lot of helpful information that we invite you to take a look at that may affect your business as we get back to something close to normal operations. In particular, one of the things we're starting to see in the wake of COVID-19 is an increase in financially distressed, clients that are experiencing financially distressed customers and suppliers. And we're seeing that a financially distressed supplier in a lot of respects can be more serious than a financially distressed customer. A customer that defaults on an obligation to your business may not pay their bill, and you may have to write off a debt. But if a supplier encounters financial distress, that can affect your business's ability to obtain inventory and to meet its commitments to its customers. So tomorrow at 11, we will be hosting a webinar that we'd invite you to join on WNJ.com. I'll be presenting along with one of my partners, Gordon Turing, on ways to mitigate the risk of a financially distressed supplier and what that might mean for your business. So with that, thank you, Tony, for the opportunity to spend a few minutes. And again, thank you to the Midland community for pulling together in the last week. It's really been quite something to see. Thanks much.
Great, and thank you, John. Really appreciate you joining us. Safe travels, and we do appreciate Warner Norcross and Judd LLP for their support for our programming. So additionally, I want to make sure we recognize our members who help make programs such as this possible throughout the entire year. I want to just kind of take a moment to thank our 2020 Platinum and Diamond level sponsors for their commitment to the Midland Business Alliance and the work that we try and do. You can see their logos on the screen. I'm just going to run through them. Our Diamond partners: First State Bank, Beerline Companies, Blue Cross Blue Shield of Michigan, Bone and Bailey Insurance Agency, CBM Services Inc., Chemical Bank, a division of TCF National Bank, Corteva AgriScience, Dow, DT Energy, Fisher Companies, Garber Chevrolet, Yiter Insurance Group, Isabella Bank, Members First Credit Union, Mercury Telecom, Midland Cogeneration Venture, Midland Daily News, Mid-Michigan Health, Octagon, Dow Great Lakes Bay Invitational, Saginaw Valley State University, Spence Brothers, Trinzio LLC, and Three Rivers Corporation. We really appreciate that partnership we have with all those diamond level partners, and certainly our platinum partners: Central Michigan University, Great Lakes Bay Regional CVB, the Greater Midland Tennis Center, Northwood University, Posnack Dyer Kanar Shefsky Thompson PLC, Stanley Steamer, TriStar Trust Bank, and Wildfire Credit Union. We want to thank these companies for providing their support all year long. And it's, as we've talked, it's a different fashion than we might have imagined at the beginning of the year, but we still think it's critically important. So just give you a couple quick updates in terms of the Midland Business Alliance. You know, we're still trying to help in every fashion that we can. in terms of obviously as a community so focused on helping those in need. We did have our farmers market this last Saturday. We did it at the Dow Diamond parking lot, just on the far side, kind of away from the East End building, and those big parking lots there. We're going to do it again there this Wednesday, and it was great to see so many vendors out there and people. We had about 250 folks come through. It's drive-through only for probably another week or two, as we kind of figure out how we can open it up with the COVID-19 regulations. But we also made this a opportunity for people to drop off donations, and we're going to do that again this Wednesday from 7 till 1 o'clock. We'll put up a list in terms of working with United Way about what people need, and so we'll put that up there. So if you're out and about and you'd like to come by, even if it's just to drop something off, that'd be great. We'd love to see you there. We're still helping to promote businesses. That's something we've been very focused on. And so we've done a great gift card giveaway, which we put a little pause on last week. But we're doing it for 40 days, where we give a $100 gift card away for a business in our community, and it's also just a chance to promote them. And as we're going through this this period of time we're in, and so please check that out on our Facebook page. We'll keep our information on our webpage, mbami.org. A lot of information out on Facebook. Try and put out emails. So please look at those, and if you're not getting something, let us know that. I did want to give a few reminders about events that are coming up in terms of programming. We do have, we did a virtual Wake Up Midland in May. We're going to do our next one on June 5th. So a week from this upcoming Friday. It begins at 8 a.m. So be sure to register on the website so you'll receive then the link like you have this morning to the virtual event. And just 1 hour is fast paced like we do when we all get together in person. But I think there was great information. We talked with Mid-Michigan Health, and we're going to do that again, have some important information for all of you. So hopefully you can join us. We've had our annual educational seminar was scheduled in June. Now that's obviously changed. We're going to have a great speaker come up. So what we're going to do this year is we're going to have a short virtual event open to everyone at no cost. It's we're going to follow it up later with it in person, but the topic is very timely, more than we probably could have imagined when we scheduled this. Our presenter is Ann Grady. She's the author of Strong Enough: Choosing Courage, Resilience, and Triumph, Mind Over Moment, Harnessing the Power of Resilience, and 52 Strategies for Life, Love, and Work. Also, she's on Transforming Your Life One Week at a Time. So her topic will be on resilience, and this was kind of scheduled before we really got into 2020. So it's a topic needed more than ever. So please look and join us. We're going to be having this short update, or this free shorter segment coming up in June, and so we'll have that information out there. And then when we want to have that longer one, hopefully in the fall, we'll be able to do that. But again, something that hopefully you will all find value for, and you can help get the word out. So with that, let's get into today's program topic. Our presenter this morning comes to extensive expertise in the area of economics. And as we kind of look at an ever-changing world, Dr. Tim Nash's information, I think, is really going to be vitally important to hear. So I'd like to introduce Diane Middleton. I talked to Diane's doing just an incredible job as our Vice President of Advocacy, and have her introduce our speaker, Dr. Timothy Nash of Northwood University. So I'll turn it over to you, Diane.
Great. Thank you, and good morning, everyone. Thank you so much for being with us. We actually scheduled this Issues and Answers program I think back in November. We thought, gosh, we haven't had Dr. Nash in so long. He does a great job of explaining economics. If you're not an expert in it, that is okay, because Dr. Nash has a wonderful way of unpacking all of it and making it very, very easy to understand. So we thought we would have him. We went ahead and scheduled him for the end of May. When we scheduled him, we thought, you know, this will be great. Things are on the upswing. We're going to get a wonderful economic forecast of how things are going to get even better. And about 10 weeks ago, the bottom fell out of everything. So this is going to be a very different presentation than we had planned at that point in time, but more relevant than ever before. And this will give us a great idea of what's happening economically at the state and federal level, and how the pandemic has impacted decision-making with state and federal economics. So not to take any more time away from our speaker, I will go ahead and very briefly introduce him, and then he can get underway. So we're very pleased to have Dr. Timothy Nash with us here this morning. He joined Northwood in 1980. He received a bachelor's degree from Northwood, a master's degree in economics from Central Michigan University, and then his doctorate degree from Wayne State University. Dr. Nash leads specialty programs, research, and continuing and executive education programming for Northwood University system-wide. He is a professor of economics and business for the undergraduate program, and he's also a professor of economics and public policy at the DeVos Graduate School. He is also the director of Northwood's McNair Center for the Advancement of Free Enterprise and Entrepreneurship. Dr. Nash is the holder of the McNair Endowed Chair in Free Market Economics at Northwood University as well. His travels and research have taken him to over 30 countries, from China and Mexico to Poland and Switzerland, where he has also participated in academic colloquiums. Dr. Nash is an adjunct scholar with the McNair Center for Public Policy, an adjunct scholar with the American Legislative Exchange Council in Washington, D.C., and is the former state director of economic education for the clergy of the state of Michigan. He has co-authored 4 books, including When We Are Free and In Defense of Capitalism. He and his colleagues have conducted research and consulting for a number of Fortune 500 companies in their industry associations, including the National Automobile Dealers Association, the Motor and Equipment Manufacturers Association, Auto Care Association, you're seeing a pattern here with automobiles, and the Michigan Chamber of Commerce Foundation as well, Chrysler and Dow Corning Corporation. He is responsible for researching and publishing the Northwood University's annual economic forecast, Northwood's monthly economic outlook, the Auto Care Association's monthly industry indicators report, confidence indexes, which are done in conjunction with Northwood University. He annually leads a team of economists from around the country and produces the highly regarded Michigan Economic Competitiveness Report. His team has also conducted a similar study in Illinois, West Virginia, and Texas. He has addressed national and international forums related to the economy and automobile industry in China and across Europe, and of course, North America as well. He serves on the boards of the Free Enterprise Institute in Houston, Texas, Junior Achievement of North Central Michigan, Great Lakes Bay Economics Club, Therese Construction, and Mid-Michigan Health. He's a frequent guest on a number of TV shows and radio shows as well, and his writing and interviews have appeared in publications such as Detroit News, Philadelphia Inquirer, Aftermarket News, the New Jersey Star Ledger, USA Today, Chicago Tribune, and on and on. He does reside in Midland with his wife, Pam. They have 4 adult children, and his pride and joy are his 11 beautiful grandchildren. And with that, thank you so much for joining us today, Dr. Tim Nash.
Well, thank you, Diane. I first and foremost would like to thank Diane and Tony for this opportunity, as well as John Lauterbach. John Norquist is our law firm, and they just do an amazing job. So thank you, John Norquist, Warner, and Judd. The other point that I'd like to make is that, as Tony noted, you know, when you look at where we are today, ladies and gentlemen, it's an honor to be with you. It's an honor to talk about the economy. It's gotten a little bit more difficult with the COVID and for us here in mid-Michigan, COVID-19 and a flood. But the bottom line is, it reminds me of a dear friend and mentor of mine, Milton Friedman, in which he said, given the chance, free people will always rise above adversity, and we must always remember that free people can and do accomplish great things, often when people don't think that they can. And so I think this is one of those times. We need to pull ourselves up by our bootstraps. We need to help our neighbors. We need to help our community. And Midland and Michigan in the United States will be a far better place because of all of this over time. And as John said, there's never a time to be more proud of being an American, of being a Michigander, and certainly of being a Midlander. And we will overcome this, and we will look back on these difficult times and say that they were difficult, but they were also our finest moments. Again, I am honored to be here today as your speaker. I apologize for your inability to see my mug, but most of you that know me know that I have a face for radio, so that's a benefit for you at this early time in the morning. Diane is going to move the slides along for me, so I think this will go quite well. When we look at the information I'm about to present to you, about 3 months ago, we started to have some discussions at Northwood, and especially our relatively new president, Kent McDonald, he's a great human being. If you haven't met him, you oughta spend some time with him. He is the real deal, and we're privileged to have him as our leader. And we were beginning to talk about these pandemics, because when Kent was leading a Canadian university a few years ago, before he came to Northwood, they had much more of an issue with a couple of the viruses that did not stay or were not the results of situations that required quarantining in the United States. And we began to look at, if this hit the United States, what kind of an index could we put together to be able to track the notion of the current condition in the economy, and when would we be recovering? So we spent a lot of time, my colleagues and I, and especially Kent and I, and we looked at what was happening in South Korea at the time, China, although I don't want to be political, but I don't believe the data coming out of China at all. So South Korea, Italy, some of the European countries that had data and had the pandemic there before it hit the United States. And we put together what we are describing as the Northwood University COVID-19 Optimism Index. And so what I'd like to do first and foremost is just to take you through that a little bit, tell you about the impact that index has had. And then, if you'd like to get the index daily, it comes out daily. We just put our 60th issue out a couple of days ago. You can get a hold of me or get a hold of Diane, and we can figure out how we get you on that mailing list. But we looked at all the different variables, and we said, we've got to do something that we can do daily and that has key factors that are not real complicated. We played around with some pretty advanced mathematical models and realized that we'd spend every waking hour of every day explaining them to individuals. So we had to make them relatively simple, but we had to have a good sampling of all the key variables in the economy. So what we did, and you can see on that the first slide past the cover slide, we have the 7 variables that we use in the index. And those 7 variables are COVID-related deaths, COVID-related cases, the COVID mortality rate, and it's a simple mortality rate. It's just the number of deaths divided by the number of cases, gives us the mortality rate. We then said, what will be great proxies for just the general state of the economy? And so we said the Dow Jones Industrial Average, which has our own Dow Chemical in it, but the Dow Jones Industrial Average has the major players in the economy. the big stocks. So the first stocks to ever go above $1 trillion, like Apple as an example, Amazon. And so it has the 30 largest, most prevalent stocks across different industries. Someday soon, I think they're going to change the name of it from the Dow Jones Industrial Average to the Dow Average, because it's no longer an industrial stock index like it was over 100 years ago in 1890 when Dr. Dow coined and developed the Dow Jones Industrial Average. Second variable that we measure is the NASDAQ, and the NASDAQ is really important because it measures our high-tech industry. And as you'll see in my remarks, not only is high-tech the most important driver of the current state and the future state of the U.S. economy, but it has rebounded very quickly from the early declines in March of this year when the pandemic was really beginning to take root here in the U.S. The third variable that we look at, or number 7, the third in the stock category, is the Wilshire 5000. Not a lot of people follow that unless you're really into stocks, but the Wilshire 5000 is the broadest based across many industries and many parts of the country. It's the best single measurement of the overall stock market in the United States, in my opinion. And so you've got the pandemic with the first 3 variables. You have the general economy with the second 3 variables. And then the last but not least is the 7th variable, or the U.S. Treasury bond yield. And that takes a look at risk. That takes a look at how people are feeling about what's happening now and what's happening in terms of the future, but it's an immediacy relative to risk. The prior 3 look at conditions. That last one, the 7th one, looks at the overall risk. And if you remember, those of you that follow stocks more closely than others, and you follow the economy more closely, or for all of you, if you remember from your macroeconomics classes or your early finance classes, if you had one in college, the 10-year Treasury bond yield is something that works along the following lines. When the Treasury bond yield, meaning the return on the bond, what you're going to get paid, the interest rate on it, when that begins to go up, what that means is people are saying, I feel more confident in the economy. I'm going to buy stocks because stocks pay a greater return, a greater rate of return on my investment. When people are feeling less confident in the economy, the Treasury bond yield goes down because people are saying, I don't want to invest in the stock market. I'm worried about what's going on in the economy. I'm worried about these companies and their investments and their ability to sell and grow their business, to satisfy customers, to have customers, whatever the scenario is. And so when the Treasury bond yield goes down, it's generally a sign that the economy is beginning to slow, that people are less willing to take risks, and therefore the government doesn't have to pay as high a rate of yield to get people to buy the government Treasury bonds, in this case, the 10-year, because people want security and they believe that the Treasury bond, since it's guaranteed by the faith and good practice of the U.S. federal government, it's guaranteed and they want to buy the bonds. So bond yield up. Generally, government's got to pay more money because the stock market's paying a good rate of return. And clearly that's been the case the last, quite frankly, overall the last 10 years. Now, if you remember, in the first couple of weeks in March, there was a 2-day period when not only did the Treasury bond yield go below 2%, it went below 1%, and it actually settled at 0.4%. And if you go back and look at what happened on that day, ladies and gentlemen, not only were people losing confidence in the stock market because the stock market was crashing, the three indices that I mentioned that we have in our index, in mid-February, they were all at all-time record highs. And by the second week in March, they were down almost 40%, each of them. Not quite, but almost. So people were saying, I don't want stocks, and they took their money from stocks, put them into Treasury bonds, but something happened. People even said, wait a minute, I'm not sure I want government Treasury bond yields. I'm not sure that I think government's the solution or that government's doing things right. And they began to move their money out of 10-year Treasury bonds and move the money into cash. And then for one day there, they actually moved it out of cash and into gold. And for a while on that day, gold got above $1,800 an ounce because people were really worried that there could be a major collapse in the economy. And the U.S. government stepped in. It stepped in with some fiscal policies. It stepped in with monetary policy. The Treasury and the Federal Reserve got together and agreed that there would be at least $3 trillion of liquidity provided into the economy, and things began to stabilize. But one thing that you can see with the index and the data that I'm showing you moving forward is that people are not confident with what's happening yet. And they're very worried about what the government is doing. Not that it shouldn't be done, not that these aren't good ideas to help, because this is not an economic crisis, ladies and gentlemen. This is a black swan. And quite frankly, there's going to be some great public policy cases written about our flood and the dams and who owns the dams, who was reliable. So these two events impacting Midland, COVID-19 and the flooding due to the dams, these are things outside of normalcy that are you would describe a mini black swan and a major black swan, meaning the dams and then the COVID-19. So the thing that people are worried about moving forward is that the national debt is going to increase, and it's going to increase dramatically. And it already is increasing, but I would not be surprised to see the national debt of the United States, which is currently, total national debt is 106% of GDP, or at least it was a few weeks ago. By the end of next year, I'm convinced it'll be at least 140% of GDP, which by U.S. standards is I'd say borderline outrageous. It's going to be difficult to handle. Just so you know, at the end of World War II, after we fought to liberate Europe and the rest of the world with our allies, like Canada and England and France, etc., our national debt as a percent of GDP was 119%. So right now, this debt has to be taken care of. And I will say to you, I don't believe that higher taxes is the solution, or would be the solution. I think that if you remember, in the coming out of from 46 to the end of the 50s, we had relatively slow economic growth, and it was a Democrat and, in my opinion, one of our great presidents, John F. Kennedy, that signed into law. Unfortunately, he didn't live to sign it into law, but President Kennedy took the top tax rate from about 92% of income and reduced it to 70%. And that's when economic growth really started in this country. And by the time Ronald Reagan became president, our national debt was about, between somewhere, depending on whose estimates you look at, somewhere between 61 and 65% of GDP. And unfortunately, we've gone on a real spending binge. And I believe, this is kind of a side note, but maybe another topic for another day, is I think we ought to be looking at what it would take to have our national debt be curtailed by having a balanced budget amendment like most of our states have. So again, if you look at these indices, and in the interest of time, if some of you want to know how it actually functions, it's not real complex math, but we come up with, if you move Diane to the next slide, you'll see that our index, we're getting real close to what we believe is a recovery zone, which has to hit between 65 and 70 is the beginning of the recovery zone. We're at 60% right now. I think based on where the stock market is, I was watching Bloomberg before my presentation started, and the early preliminaries for the stock market today are up over 400 points. So I think that we could be at 62 based on my gut level, where I think the index will be for tomorrow. So I think we're getting close to that. The next slide, you can see it's our tracking of total cases. And if you can see, we went from very few cases to today we're at almost 1.7 cases in the United States. And also something that we didn't track initially, but we kind of informally tracked. In the last 5 weeks, we've gone from having 1 million tests to, as of yesterday, ladies and gentlemen, we closed at 4.2 million tests in the United States. So we've made a real person's effort to have more and more tests, with certainly what you'd expect cases to rise, but the more tests we can get out there, the more data from those tests, the easier we'll be able to have very good scientific solutions to deal with the pandemic. All right, so cases will always go up. It'll never go down in terms of total cases. Cases on a daily basis will go down, as well as the next slide, which shows total deaths. Total deaths were, as of yesterday, we were at just over 98,000 total deaths, and that is something that is higher than many experts thought it was going to be. But initially, it's much lower than the original estimates. The CDC said if we didn't quarantine, we might have had as many as 1 million deaths. So it certainly is a vicious virus. The next slide shows the mortality rate, and the mortality rate is a daily rate, and it's simply the number of cases for the day divided by, the number of deaths for the day divided by the number of cases. And you can actually see that when you hear people talk about things flattening out, it has flattened out, and it's actually beginning to decline. And one of the things that I think is important for you to know is that we measure things every day at 4 o'clock, because that's when the stock market closes. And as long as we're consistent, we measure via the Johns Hopkins website total deaths, total cases, the mortality rate, and then the indices we measure, and the yield on the 10-year Treasury. And then on Saturday and Sunday, we keep the same stock figures because the stock markets are not in place, and we simply then add the change in cases, deaths, and the mortality rate. And we do it every day at 4 o'clock just for consistency. All right, now if you look at the next slide, you can see that low area in March, that's when the Dow Jones Industrial Average went below 19,000. Now you have to remember that in February, about a month earlier, the Dow Jones Industrial Average was at an all-time record high of just over 29,500 points. So it dropped to roughly 18,300. And now if you look at, it's back up above 24,000. And today it's threatening to go above 25,000. If you look at the NASDAQ, the thing that's important is that the NASDAQ has already moved up at the level that is above when we started charting. And just so you know, we started charting this. We went back and constructed the data at the original date of the first death, because there you had a market reaction. That was the end of February. So our data is the end of February. Now, some people say, well, Nash, there's a death that was confirmed that was in January. There's another death that was confirmed in early February. That's true. We now know that. We didn't know that until just recently. But because the market didn't know it, there was no reaction to stocks or to bonds from that. So we've stuck consistently with the end of February to date with our tracking of data. And what you see here is that the NASDAQ is actually at a level above where it was at the beginning of the pandemic. And the NASDAQ has almost reached its all-time record high of mid-February. And why is that? Because the high-tech stocks are getting us through this COVID-19 pandemic. When you're looking at buying food, ordering things online, you look at the high-tech companies that are coming up with solutions and methodologies. These companies are not only are the stocks doing well, but the fact of the matter is the profits are really beginning to move in the right direction. You can see the Wilshire, and the Wilshire is moving similar to the Dow Jones Industrial Average, but the Dow Jones Industrial Average is the one that is lagging behind in terms of overall growth. Now, if you look at the 10-year Treasury bond yield, look at that early in March. You see that one glitch where it goes down to 0.4. That's that day I was describing for you with what happened with the dollar, with gold, etc. And so here's the tracking of our broad-based index and how things have changed. We have what we call more of a technical index, but instead of breaking each of the categories into fifths, we break each category into tenths. And so that gives us a little better measurement, a little bit more consistent measurement, but it's more technical, it's more difficult to explain. If you look at the next chart that you can see, you see the daily change in COVID cases, and you can see that that's sloping very nicely downward and to the right. So our total cases are going up, but the cases per day, the average cases per day are beginning to decline. And the same thing with the next slide. You can see the change in deaths per day, and the average number of deaths per day is beginning to decline. You know, one thing that you might find interesting as you look at the data, we have 3,143 counties in the United States. If you include, the state of Louisiana that has parishes, we call them counties. We have 3,143, and roughly 54% of those counties have had 0 deaths due to COVID. Or another way of looking at it is, if you looked at the top 12 counties in the United States, the largest in terms of deaths being New York City, the top 12 counties make up 34% of all COVID deaths in the United States to date. Or if you look here in Michigan, if you take Metro Detroit, which would be Wayne County, Oakland County, and Macomb County, add Genesee County, so those 4 counties that link together in basically southeast Michigan, the first 3 are about 84%, and if you add Genesee County, those 4 counties then make up 86% of the cases and deaths in Michigan. And that presents an interesting discussion of whether or not one size fits all. We say that we're going to depend on Judge Brandeis. John, I hope you're proud of me bringing up Judge Brandeis. But Judge Brandeis, in a famous case in the 1930s, described our 50 states as our 50 laboratories of democracy, and said that our 50 laboratories of democracy can, and via the Constitution, are given the power to do a lot of things as they see fit. And that's why the 50 states are doing things differently in terms of coming out of the pandemic. Well, in an editorial that Kent and I wrote that was in the Detroit News in the last week, we also suggested that if a one-size-fits-all doesn't fit at the federal level, meaning if all 50 states should have the ability to do things differently, then one-size-fits-all probably doesn't fit within a state. And if the vast majority of our cases and deaths are in Southeast Michigan, in my hometown of Detroit, then maybe the rest of the state should be able to do things a little differently. That's just, you know, a big question to ask, and I know we're certainly debating that. And then if you look at the next slide, it has the COVID mortality rate. It also, the slide after that, has the mortality rate in comparison with the number of deaths. If you look at the slide after that shows changes in the mortality rate relative to the broad-based index. And so, you know, we've just tried to every day measure the pandemic and to measure how we're trying to fight back and how the economy is recovering. We've been so pleased at how well the index has been received. The Michigan Chamber of Commerce is using it as part of their recovery toolkit that they're sending on a regular basis to all of the state chamber members, more than 20,000. A number of national organizations, the Truckload Carriers Association, are sending it to all their trucking companies across the country that are members. The Associated Builders and Contractors of America are using it with all their state associations and at the national level. At the state level, Lee Chatfield, Speaker of the State House, Mike Shirkey, Senate Majority Leader, our own Jim Stamas are using it. John Molinar, who was involved in an op-ed with us related to some of this material about a month ago in the Detroit News. John gets it every day. A good friend of mine, Jeff Teller at the White House, he gets it every day and says that he periodically shows it at least once a week to the Vice President and the President. I was honored to be asked to be part of a national task force with people like Newt Gingrich and Steve Forbes and Arthur Laffer, Bill Bennett. We meet once a week by phone, and this is one of the topics that we talk about in the overall recovery. So we've been honored that we're getting that kind of attention and that the index is being found to be useful. You know, I get people calling me saying, isn't there something you can do to make that thing go up? And, you know, unfortunately, I have no control over it, but I do think we as a team put together a really good index that is predicting, you know, fortunately or unfortunately from day to day, how well the economy is going, and in a general sense, how more closely we're moving toward a COVID, what's the best way to put it, a remediation of the COVID-19 virus and a recovery. And I would simply say to you, if you went back, or for those of you that are on the call that have been getting it, when there's a bad response, when a governor says something, especially when Governor Cuomo was delivering bad news, the stock market went down, the index went down. So the stock markets are very good indicators of measuring what's going on and the impact it's having on the economy. The next slide that has the different colored bars that are horizontal bars, that's just the 60-day average. We took a look at the 60-day average the other day because it was the 60th day that we were putting things together, and you find out that in most areas right now we're above the 60-day average, which is also a good thing. You know, unfortunately, we're above the 60-day average with the mortality rate, but I can report to you that the last 5 days the mortality rate's coming down, and if it dips below 5.91, which it was yesterday, we'll get a little bump in the index. And so I think that my hope, my guess, with all the testing, all the remediation, that's happening. We can expect a much better mortality rate, an average mortality rate, meaning a declining one in the weeks ahead. All right, down to the challenging things. As Diane noted when she asked me to be part of this program, we were looking at a very good economy, a robust economy. I like President Trump. I voted for him. I'll vote for him again. I think sometimes he talks too much. I wish he would not tweet as much. And I wish he wouldn't talk as much. And I wish he wouldn't say things like, this is the greatest economy in the history of the United States. It's not. It's a good economy. It's been a very good economy. It's an improvement from President Obama's economy. But it's not the greatest economy in the history of the United States. And it certainly is nowhere near as good as the economy of, say, Ronald Reagan, if you want to brag as a Republican. But there are and have been some very good factors. Stock market's been at record highs. Unemployment's been at or near record lows. But the one thing that hasn't been the greatest component has been gross domestic product growth. And if you look at it from the end of World War II till the time of the Obama administration, U.S. real GDP averaged 3.3%. You can see based on the data in front of you, we did not average 3.3% last year. This year, unfortunately, those are our preliminary figures. I hope they're a little bit too strong, but we're calling for negative GDP in the second quarter for the U.S. and thus proportionally similar for Michigan and Midland of not quite 40%. We think the third and fourth quarters will be an improvement. We're going to come up with our final numbers. I just came up with something for this talk. You know, once the flood got in here, it really threw off some of our models because we're going to have billions of dollars of damage in mid-Michigan due to the flood in all likelihood. So we've got to take some of those variables into consideration. I think we may get to 10 or 12% growth in the third quarter and maybe double digits in the fourth quarter. But this is our preliminary data for right now. I think that next year we could hit between 4 and 5% on the high end. And then I think because of the debt, because of the cost of the debt, because of what that's going to mean to higher taxes, more government spending needed, I think we're going to start to see the future, meaning 2022, be potentially somewhere between 1.5% and 2.5% growth at best. We really are going to be saddled by the debt. The next slide shows consumer confidence. And as you look at consumer confidence, it's down, but it actually started to pick up last month. So we took a big tumble the last couple of months, but I think consumer confidence is beginning to move in the right direction. The doozy right now is the next slide, which is unemployment or jobless claims. You know, right now we're at about between 38 and 39% unemployment. That, ladies and gentlemen, is a bit of a misnomer. I was not in favor of the package that provided an extra $600 a week in unemployment. Just so you know, that means that the average person who's unemployed is getting paid about $51,000 to $52,000 a week in Michigan, and it goes until early July. So the problem there is that you've got a lot of people that are saying, why should I come back to work? And there are a lot of good people with good jobs that are being paid less than $50,000 a year that are now being paid over $50,000 a year, and they're saying, well, I don't want to come back, or I'm really worried about the pandemic. And it's difficult for employers to get those individuals back to work, and it's very difficult for those companies to say, hey, if you don't come back, I don't have a job for you, because a lot of them have to try to bring back a 75% or more so that the money that was given to them as part of the federal program becomes a gift rather than a loan, and they get to keep the dollars without any payback necessary. So right now, the economy appears to be a lot stronger than, roughly 20% unemployment like we have today, because those people that are unemployed, most of them, not all of them, but millions and millions of them are getting paid the equivalent of about $51,000 a year on an annualized basis. So that's the weekly unemployment check they're getting. When that expires, that's when the economy needs to be moving. And that's why a lot of us are concerned that if we don't get the economy moving by the time those dollars expire, we're going to have to add even more money, another $1 trillion to the economy. And then if you extend that unemployment for another 26 months, those people aren't going to come back to work, and we're going to, instead of killing hundreds of thousands of jobs via COVID-19, we'll lose 1 million jobs. I'm sorry, not jobs, but companies. The estimates are we've lost at least 100,000 companies, and that we could lose, if we extend the unemployment again, it could be as many as 1 million businesses go out of business. And just so you know, as a point of reference, my much better half, Pam, is from New York. The average unemployment check in New York is about 60,000, and the high, depending on where you live in New York State, is 72,000 if you're on if you're collecting unemployment, if you include the 600 from the federal government. This next chart just shows you where some of the original $3 million was spent. The next chart shows you where the dollars, the 4 countries, and look at what's happening to the budgets of those 4 countries as a result of all this additional government spending, because we're not the only country that's resorting to looser monetary policy and increased government debt to make it through the pandemic. And many of you know me as a real free market economist. Milton Friedman, the great economist, the Nobel Prize winner, who wrote the foreword to our book, When We Are Free. I'm a disciple of his, but I think even Dr. Friedman, if he were alive today, would say this is a black swan. This is a pandemic that was totally unexpected. This is a legitimate role for government. The problem is we're making it too political. Again, our politicians are putting money in there for things that they shouldn't. And at this point, I don't think the federal government should be doing more. I think we should be loosening up the economy to let the economy heal itself. And we need to continue those debates in the state capitals across this country and certainly nationally to get the economy moving. Last but not least, I thought I'd give you just a couple of simple examples. Here, if you look at Goldman Sachs, a lot of investment banks and investment companies are putting their own money out to complement and supplement what the government's doing. So here's just an example of what Goldman Sachs is doing to help businesses large and small. And then finally, because as Diane noted, we have 11 grandchildren, and a couple of years ago, because I've been able to successfully keep my wife away from a good Midland optometrist, we were married. We celebrated our 40th wedding anniversary a couple of years ago, and we took the family to Disney for our 40th wedding anniversary. It was a great time, and we bought each of our kids some Disney stock for each of our grandkids some Disney stock for their college funds. So we all track Disney stock, and right now, if you look at it, old Mickey and Minnie are missing all of you. Park revenue is down dramatically. Most revenue for Disney is down dramatically. Disney hasn't recouped the way Dow has under the great leadership we have here in Midland. And so, there's a stock that I think you really need to track, because to know we're really coming out of this pandemic, if you track Dow or if you track Disney stock, it means people are driving from state to state. They're staying in hotels to get to Disney World. They're flying to Disney World. They feel confident about taking vacations, which means that their income, they feel good about, they feel stable about. So there are a number of key reasons why a rising Disney stock is a sign that the pandemic is slowing, and eventually when Disney stock gets up above its old levels, it's a sure sign that the economy has healed itself, and we probably have a virus, a vaccine for the virus, etc. So those are just some key issues and key variables to take a look at. In terms of the Michigan economy and the Midland economy, I think that we're truly looking at similar situations to what's happening in the United States. I think Michigan, unfortunately, is going to be hit harder than the national economy. I think Michigan's GDP, when we measure it for the year, will be down about 43% rather than upper 30s, because of the impact on the auto industry, because we kept the auto plants closed longer, and quite frankly, because Michigan has kept the state a lot more tightly sealed than most other states in the country. You can argue, you can debate that, as we all are in our own homes and in town and at the state level. But the fact is, Michigan has ceased to open up. And I would not be surprised to see Michigan GDP for the second quarter get as low as a negative 50%. Midland, I was going to say, was faring better for the second quarter until the flood hit. And I think there will be some pluses to the rebuilding of the flood in the second quarter. There's certainly going to be a lot of negatives. And once again, we need to help our friends in need individually and through the agencies that Tony mentioned. But I think overall, the Midland economy is probably going to shrink about 30% in the second quarter as a result. So, Diane, those are my remarks. I hope they help, and I would love to take any questions if the audience has any.
Okay. Thank you very much. A lot of great information. I do have some questions, but I invite our audience to submit their questions. At the bottom of your screen, you will see a Q&A function. Simply open that up and type your question in there, and then I'll share it with Dr. Nash. So anything can go in there. But I do have a couple of questions that perhaps a number of us share. So let's see here. So maybe the main question for those of us who are certainly not as schooled on economics as you are. So how long till we're fully recovered? And what's your best guess? How long will this take? How long will it take for our stock portfolios to bounce back and for our economy to be robust once again?
Well, Diane, if I had the answer for that question, I would be sipping pina coladas on my own private island in the Virgin Islands. And if I had $1 for every time somebody's asked me that in the last couple of months, I'd have enough money to take care of the flooding issues in Midland. I would simply say the following. I believe that it's going to be what I would describe as a slow recovery, a slow V recovery. And I think that all of this depends on how quickly states like Michigan, California, Illinois, New York decide to open up their economies. If those open up quickly, we will see a V recovery. If not, we're not going to see a V recovery. And with your stocks, if you're in the NASDAQ, you have recovered in general most of your stock prices, some more than others. I think that the stock market should get back to its old levels by the end of this year, maybe early in 2021. However, the thing again that I worry about is how are we going to pay for the debt that we're running? You know, right now, gross interest on the national debt at about 2% interest, that's the average rate, is right now about $460 billion. Just think if the national debt goes up another, $5, $6, $7 trillion, and just add 2% of that to the national debt. We could have, in theory, if the interest rates go up, and I think they eventually will start to go up by the end of the year, if the average interest rate goes to 3% and the national debt goes to 30 trillion, we all of a sudden have gross interest on the national debt instead of about $500 billion, it's about $1 trillion. And where do we come up with the money to pay for that? That certainly will slow down the U.S. economy and our ability to do business and our ability to see companies prosper. If the government is taking more in taxes or more, to pay for government funding. So that's a real concern that no one can debate is an issue 6 months to a year down the road. We have to figure out a way to grow the economy. And I think the only way we can do it is to sign into law a balanced budget amendment and to cut taxes in a relative sense the way John Kennedy did after World War II to get a stagnant American economy growing in the early 1960s.
Okay, thank you. Dr. Nash, what about our hardest hit sectors? For example, we've all heard a lot about how restaurants and lodging and retail and whatnot, and healthcare as well, ironically, have really been hit very, very hard. What's ahead for those sectors?
Well, I think it's a great question. And, those of you that know me know that I'm not the slim guy I used to be. And part of that is due to my unabashed support of the Midland restaurant community. And so I think all of you need to, the old Michael Jordan, I want to be like Mike. I would simply say you ought to adopt the I want to be like Tim and support the local restaurants in any way, shape, or form that you can. I'm not going to name names, but when Pam and I call up and we go to one of our favorite restaurants and we buy a dinner and bring it home, it's just amazing. They've always been great restaurateurs, and I know all of you know the people that I would be mentioning, but I don't want to point one out at the expense of another. But you see tears in their eyes and a big hug. So I think we need to continue to support those industries while simultaneously, hoping that they can get some funding. Ironically, if we don't open up this economy, we're going to lose tens of thousands of restaurants in Midland alone. We have to begin to open up. So the only thing we can do in the short term, Diane, is to support those restaurants, to support those businesses in any way that we can, have them deliver a catered meal to your house, go pick up a dinner if you can. Give a gift certificate to people that are in need. I took some money to some friends that have been hard hit by the flood over the next couple of days, and brought meals from restaurants that are having some challenges, and it's sent all the right signals. But if we don't open up, we're in trouble. And hospitals, I'm not faulting anybody, but some of the the negatives that were going to hit hospitals didn't take place. So we've said to a lot of hospitals, you can't do certain things. You can't do normal routines, normal testing, because you got to be prepared for the pandemic. We have to quickly say the following, and this is my opinion. I'm on the community advisory board for the hospital. It is a great hospital. It's a great team of leaders. We're blessed to have Mid-Michigan Regional Health headquartered here in Midland. But we have to say that these people especially know the best way to handle the pandemic, the best way to conduct their regular business, and to help out in the case of a needed uptick in COVID-19 cases. And again, I think we need to be talking about the fact that one size does not fit all. I would much rather see the leadership of our hospital community in Midland make the decision rather than out of Lansing, because Midland's a lot different than Lansing, and certainly a lot different than my hometown of Detroit.
Okay, thank you. I'd like to...
And that was Tim Nash speaking, not Northwood University.
Okay, all right. I would like to remind our attendees that you can submit your questions with the Q&A function on the bottom of your screen. You may have to run your cursor over it, but it is there. I know that you have better questions than I do, so go ahead and submit those. But I do have a few more. Dr. Nash, we all know that the state's budget, both for this fiscal year and next fiscal year, and in probably going forward, has some multi-billion-dollar holes in it. So what about the catastrophe that Midland just experienced last week? What's your guess about how that will impact the state's budget?
Well, I do believe that, again, this is a pandemic, and there is a role for the government, and the government is going to need and expect help from the only entity within our government system that can create money, and that's the federal government. So I do think it's important that we expect help, first and foremost, from ourselves, from private charities, from private organizations, but I think we also expect it from the state and the federal government. I think we will get it. But I also believe that we cannot expect that we ask for things above and beyond the things related to COVID-19, or locally beyond the additional dollars for the flooding. I think what's happening right now, when you look at a number of states like Illinois, you mentioned that we did the economic competitiveness study for the Illinois Chamber of Commerce. And one of the things that we found out in the study, and it made a lot of news in Illinois and elsewhere, was that the debt in Illinois for the state retirement funds and the city of Chicago retirement funds were astronomically high. And a number of politicians right now are trying to get federal money at a time of great crisis to shore up their pension funds. They were improperly designed. Mm-hmm. They've been improperly funded. So we have to avoid taking care of problems that are of Illinois' or California's making at the pension level when mitigating the problems associated with the pandemic or the flood. We've got to separate those two and make certain that we take care of everything that we can and should, but let's not add debt to Michigan to bail out the pension fund of Chicago and the state of Illinois, as an example, if that makes sense. So that's how I would answer it. I think that the funding will come. I think that we will find that those individuals will rise to the occasion, and we will get the kind of dollars we need to get through this and to move this great city forward.
Okay. Dr. Nash, you talked a little bit about what the pandemic, what kind of an impact the pandemic has had on economies in other parts of the world. But in your chart, I didn't see any reference to the Chinese economy. Can you speak a little bit about that? I mean, given their role in the world and the scale of their economy, can you talk about that at all?
Certainly. The Chinese economy is the second largest economy in the world based on a conversion to U.S. dollars. And if you look at the Chinese economy, it's been an economic miracle. I started going to China. Larry Reed, who started the McNair Center, I'm sure a number of you know of Larry. Larry and I went there in the late 1980s, and it was amazing to see what existed then versus what existed just recently when I returned to China, I think for my 20th visit to China. And they have become a much freer, a much more productive economy. But today, there are a lot of problems, and it would take too long, Diane, to give you all of my analysis. But the Chinese economy, I don't believe a lot of the data coming out of China. I don't think the economy has been growing as fast as they say it has the last couple of years. I think the death toll in China from COVID-19 is higher than it is in the United States. They're just not reporting it. And so I think that the Chinese economy is a vital part of the world economy, but now we're at a crossroads, and the Chinese have to decide what kind of an economy they're going to be. Because if they don't, the world is going to, I'm afraid, shut the Chinese off, the Americans, the Canadians, the Europeans, because the Chinese economy is a mixture of oil and water, and they don't mix, a mixture of communism and capitalism, and they can't continue to negotiate and work that mixture in their favor. This president's not going to allow them to do it, and that's right. They can't continue to set tariffs or to set trade restrictions when it favors them. They can't continue to engage in theft of intellectual property. And so I think that the Chinese economy, if you look at it in the last 10 years, it's slowed from 14% GDP growth. It's slowed from that to, they're reporting about 6% before the COVID-19. They're saying that they're going to still have they're saying they still had positive GDP in the first quarter, but that it was down to about 1.5%. My guess is if you had the real figures, it would have been in the -1 or 2% range. And I think that they are going to have to be a more open and honest player. And instead of trying to clamp down on Hong Kong the way they are today, I think they need to use Hong Kong as the benchmark to truly create the greatest economy in the world. And if the Chinese would create an environment nationally like exists in Hong Kong, the Chinese economy could be twice the size of the United States and a wonderful partner in 30 years. But if it continues to be an economy that abuses its people and cannot be depended on to tell the truth in a number of areas, especially like this pandemic, the world will begin to ostracize China the way it did 30 years ago.
Okay, thank you very much. I have two questions that have been submitted by our audience. So I'll start with this first one. Actually came in with a registration. This is a little bit more political. So I will ask you to answer this just to the extent that you are comfortable. And the question is, what role could politics be playing in our government's response to the pandemic?
I don't know, what the political component to all of this is. I don't know the governor very well. I will simply say that I think she has a very difficult job, and I will say nothing other than if I were advising her, I would be advising her to be much more aggressive in opening businesses, especially outside of Detroit, and also be doing the kinds of things inside the city to have a greater level of testing being done in the city, to be certain that we can quarantine who we need to in the city and in the surrounding suburbs, while even loosening up businesses in those areas. I'm not going to get political. I know a number of people that I know are, and I just don't. If I don't know an individual and I don't know their true intention. Mm-hmm. I come from a family of mom and dad and 9 kids, and so my mother always used to say, as she walked us to Catholic school, remember the Lord's looking at you every day, Timothy, and if you don't have something good to say about somebody, don't say anything at all. Okay. And so I don't know the governor to say anything in terms of a political intent, nor that, what the political intent is with the opposition in Washington either.
Mm-hmm. All right, that's very, very fair.
I'll simply say I disagree with where Speaker Pelosi and Minority Leader Schumer are coming from on a lot of the issues.
Okay. My last question is actually got a couple of different parts to it, and it's all around taxes. So what level of tax cuts do you think are needed to stimulate economic growth, both corporate and individual? And then the other part to that question is there is an effort in the state of Michigan to adopt a more graduated tax rate for individuals. So, and that would be a ballot issue that's come forward a couple of times in the past few decades. It's always failed. Now, how does that look? Does that look any more likely with the economic crisis we're in?
Well, I think that we could see, depending on how the elections go, I think we could see a permanency to some of the recent quote-unquote Trump tax cuts if the president is reelected. And I think we could see tax increases that would drive the federal economy back into recession in 2021 and maybe even into depression. I think the economy is that fragile. And so my view is twofold. One, we have to get the economy moving and moving quickly. And so I think there are 2 things we need to do. And to me, there's no debate about it. We sit here and we've had these debates. We're in a crisis, and we have to come out of it with the right type of policy. If you remember, I said to you on the call on this task force is Arthur Laffer. All of you that took economics in college, you remember studying the Laffer curve. And Dr. Laffer is on this committee, and he's a Yale PhD, taught at Stanford, Vanderbilt, etc. And his whole notion is there's an optimal level of tax rates. And his argument is that we need a 15% optimal tax rate. But that means 15%, and then you do away with all exemptions and deductions. And maybe you keep a few, maybe you keep churches in there, maybe you keep certain types of charities, certain types of not-for-profits. But then you do away with the vast majority of tax write-offs. I remember when we used to print tax books, the CCH tax series for you accountants in the room. And they would be in books. Now they're on discs, right? So you save a lot of room in your library. But I used to be able to walk into the library when the new tax books came in. I'm 6'1". I have a wingspan of about 6 feet. 6 inches. I would put my finger on one end of the books and try to put my finger on the other end, and I couldn't, because those CCH, the tax code just for that year was millions of pages, and I forget how many volumes, but each of the volumes were about 3 inches thick. And those were all the exceptions, the write-offs, the tax codes, etc. So if you did that, you would have dramatic simplification. You'd probably have fewer tax lawyers, sorry for those of you on the phone. You'd have fewer accountants because it'd be really easy to fill out your tax return either as an individual or as a corporation. You wouldn't get all the write-offs, you wouldn't get the special favors that a lot of individuals and businesses lobby for in Washington. Real estate prices in Washington, D.C. and the surrounding area would go down dramatically in value, but you'd have a simple, very low cost administrative tax program, and coupled with that, you'd have a balanced budget amendment. I'm telling you right now, we need to do something like that, which would drive the economy forward. And then simultaneously, in the short run, we're going to have to freeze spending for 2 or 3 years. And it means that we're going to freeze everything at 1% growth. Just freeze everything at 1% growth and do it at that 1% growth level for 3 years. And I'll guarantee you, we would reduce most of the debt. We'd be on track to reduce the debt, and we could have a balanced budget if we stuck with it in 10 to 12 years. That's the radical solution that we need, and hopefully there's more palatability to have those discussions today across the country, across the state, and I certainly hope that we're not looking to pass a ballot initiative that will raise taxes. I know we've defeated it. It would be very, very, very difficult for the economy if we did that moving forward. I think that we need to keep right to work. That was a great addition. It's not anti-union. It's not pro-union. It just says that if you want to join a union, you join a union. If you don't, you don't. We haven't had a major dilution of unions in the state of Michigan since the right to work law was passed, and so we need to keep that in place, and we need to do everything we can to make taxes easier, simpler, and quite frankly lower in Michigan, not higher.
Great. Dr. Nash, I hope that you're right. I appreciate your expertise, and thank you so much for navigating our technology glitches. So glad you were able to join us this morning, if only by phone. Thank you. And I'm going to turn it back over to Tony.
Great. Thanks, Diane. And thank you so much, Dr. Nash, sharing your expertise and time this morning. Incredibly insightful. The Midland Business Alliance is going to continue monitoring this issue, keep our members and the community informed. We also want to thank Warner Norcross and Judd, today's LLP, today's program sponsor. Really appreciate them making this possible. So, I've got a great team that works with me with the Midland Business Alliance. They've been doing incredible work through COVID-19, through the flood, just helping people and helping our neighbors. And so I'm proud to be part of that team. Let us know how we can help you. I know I hear from so many of our team when they talk to individuals. Let us know how we can be helping you. We want to keep sponsoring programs like this on advocacy-related communications. We send out 2 newsletter updates, e-newsletter updates each week with advocacy updates whenever it's appropriate, and we're going to continue doing that. We know this is critical information for you, your businesses, your organization. So thanks for joining us today. We look forward to continuing to work with you. Have a great day. Oh, shoot.